Okay, good morning, everybody, and welcome to this special four-part series, brand new series we've got going here at SelfWealth by Scythe, and it's going to be called. We've called it Mastering Mindset, Methods, and Markets with the managing director of ShareWealth Systems, and that's Gary Stone, who is to my left at the moment. How are you, Gary? How are you today?
Yeah, pretty good. Thank you, Roger. Looking forward to today's session, but all four sessions, we've got plenty to get through.
Fantastic. Yep, as Gary said, this is part one of the 4 sessions on every Thursday. We're going to be here, and we're going to go through some really quality material, quality education. When we decided around this show, we wanted to sort of talk about sort of unique things to people that may have been in the share trading game for a while and may not be getting where they want to get. So also trying to dispel the myth of complicated things around the share trading industry and sort of make it easier for people to understand as well and relate to. So hence why, look, Gary Stone, to me, I've known for a couple of years now, and he's just been a great person to speak to around share trading. So looking forward to getting on with this series. Welcome everyone on the other end of the line. Thank you for coming along. Don't forget this is available on replay afterwards as well. But before we get going, we must do the formalities. So I'm just going to brief over the disclaimer here. So we're just going to pop that up right now. So just remember here, SelfWealth operates under its own ABN and AFSL here. Obviously, this is all general information only, general advice only. We don't take into account your personal situation. So please seek your own financial advice. Gary Stone and ShareWealth Systems operates under their own ABN and AFSL and is not an authorized rep of SelfWealth. So any of the views expressed by Gary in this video are not necessarily the ones reflected of those of SelfWealth. Okay, so you can see all the details there. We operate as separate businesses. Any offer that you might see on this show is by ShareWealth Systems. So obviously SelfWealth doesn't receive any commercial benefit from anything, from any sign-ups or anything. We do not endorse, recommend, or warrant any strategies or views of ShareWealth Systems, but we do provide this as some amazing education to our clients and hopefully some good entertainment as well. All right. So and secondly, we do have a little bit of information here around the ShareWealth Systems disclaimer, which obviously you can find on the ShareWealth Systems website when you go and check that out. Okay, I think that's enough for the formalities for today. Obviously, you can read them below the videos if you wanted to. Let's move on now, Gary. Once again, thanks for being a part of this series. We really appreciate your time, Gary.
It's only a pleasure. This is what I've been doing for many years or decades now, and love doing it. So hopefully we can help a few more people to get better and improve at this wonderful journey called trading.
Yeah. So we've been running the SelfWealth Live series for probably around 4 years now, and it's changed a lot over the 4 years. And it had a lot of fundamentals at the start. Then we introduced some technical analysis to it. But overall, a lot of it was to do with systematic and trying to provide guidance to clients around systems and better ways of doing things. Right. So, but before we get on to the rest of this show, I do want to introduce you, Gary, because you've got an amazing list of credentials that our viewers should know about, right? So first of all, Gary is the managing director of ShareWealth Systems. Now that was started back in 1990, so you've been in the game for a long time. Well, up to 28 years. We've said it on all the media that's around here, right? You established that to provide investment systems, including training and coaching for self-directed investors, right? You had over 8,000 hours in price movement research and building systems all around this. You appeared in over 200 media appearances on TV, and radio, including Sky Business, Your Money, Switzer, Ticker TV, Money News, and 3AW. So the list goes on there. Over 50 interviews in radio in the US and America. The ones that I'm most impressed in, you can go and check them out on YouTube, right? With Jack Canfield. And then there was another one, which really, when we spoke about it, I thought was fascinating. You got to meet the Mark Douglas, who was the author of Trading in the Zone, a very good book that was part of my journey as well. So, and obviously you've been a keynote speaker in multiple conferences over time. You've written 2 books. And on top of all that, you're married with 3 children, all in the adult age, and enjoy golf, running, fitness, and camping. Gary, I don't know how you do it all. How do you fit it all in?
Well, just got to try and stay young and eat well and keep fit.
Exactly. I think that's probably the key. I think that's definitely the key there. All right, let's get going. Now, the way we're going to run this show is this is a bit of an interview format. So even though we've got some great content for you, if you've got questions for us, please do put them in the comments there in the chat or in the live chat. We will answer them at the end of the show. We're going to leave about 15 to 20 minutes at the end of the show. We're going to try and answer any general questions you have, obviously. But otherwise, we'll be here about 20 to 30 minutes talking about some amazing, some great education on how you can become a better investor and a better trader, whether you're a beginner or whether you've been in this game for a while. All right, so let's get going with our first question. Gary, look, many people assume that if you can analyze the markets, you can make money. Tell me, why isn't that true? And I'll be honest with you, that was probably me when I first started my journey about 10 years ago. I thought if I can analyze the markets I learned in about 3 or 4 months, I could make money, and I certainly learned my lesson then.
Okay, I'm going to share my screen, Roger, because we can, I'll talk to some slides, and other times I won't have any slides. But it effectively comes down to what is the difference between analysis and trading. And the thing is that most people think that if you're a great analyst, you'll be a great trader, and nothing could be further from the truth. So what I'm going to try and do is unpack the tiny difference between being a great analyst and a great trader, but the huge effect that tiny difference makes. Effectively, most people who trade the markets, and we talk about active investing here, not day trading necessarily, active investing, that's swing trading, day trading, swing trading, and what we also call position trading, which many months you have open positions. But 90% of people spend all of their, 90%, I'd say 95% of people spend 90% of their time working on analysis, trying to solve their trading problems through analysis only. And they spend very little time getting down to the crux of what makes a good trader, which I'm going to get to in a moment. Why is it different? Well, analysis is about trying to predict, protect, and be right. Okay, so people are trying to anticipate into the future what is going to happen. And they say, well, why are they doing that? Because they want to be right. And there's a subtle difference that happens in the mind between trying to predict and actually trading, executing your trades. Whereas trading is about making decisions in the now moment. The now moment is always when you are going to place the trade. And I'm sure a lot of people that watch this and listen to this will be able to think of many, many times where they've done their analysis and it's come that last few seconds just before they place the trade, they change their mind. They go looking for some confirmation. They go and think, oh, I might go and read this report or whatever, or they've got another indicator they want to look at. And that wonderful thing, that wonderful strength of analysis, whether it's fundamental analysis or technical analysis, is that it's highly, highly subjective. And whilst that's a big pro for people that makes it very flexible, it's a huge downfall as well. And you mentioned Mark Douglas, so I'm going to bring him up quite a bit through these sessions. But trading is about making a decision in the now moment, and that decision has got to align with your analysis, and your analysis has got to have an edge, which we'll talk quite a lot about. So the trading component is not all of the preparation, the analysis, and everything that happens beforehand. It's the actual execution at the time that you got to pull the trigger to do the trade, and that is where all of the mistakes are made. every single trading mistake is made in execution, not in the analysis. And some people might go, well, what do you mean? Because if I have a lost trade, that's a mistake. Well, we're going to address that as well. So markets don't reward accurate forecasters. So forecasters, predictors, and you might even, there'd be books out there. I've heard plenty of them. I've heard people talk about, technical analysis, or even, economic analysis, or fundamental analysis, market analysis. All of it is about forecasting. And that may be the case, but have you ever met a forecaster that's been 100% right? And therein lies the problem, because all forecasting is, and what analysis is some subjective opinion based on the analysis. And it's a subjectivity, which basically means you can change, the criteria based on the analysis at any given time, is what undoes everybody in trading. And that is why the statistics that come out of places like the UK and Europe, where brokers have to report to the regulator, how many people have lost money over the last 3 months, the last quarter, shows that consistently over years, 70 to 95% of active traders in all different markets and instruments end up having less money 3 months later, and that after 12 months, the majority of them stop altogether. So we've got the stats that tells us that, and this will be, in your client base, our client base, is that the majority are going to fail at this. And these are the reasons why. Forecasting is also egotistical, where people are trying to predict, and they're trying to prove that they're right? And they're also trying to, protect something that is, and that's where the ego comes into. We'll talk a bit about the ego later as well. And also, forecasting doesn't necessitate action. It's merely a statement, right? And mostly, people check the forecast after the fact, and the ones that they're right on, that they are correct on, they magnify that, and the ones that they're wrong on, they just forget about. And that's what happens psychologically with traders, is that they magnify the ones that they're correct on, and that gets an undue bias and as to how they might do their analysis, change their analysis in the future. And of course, the ones that are wrong, the ones that they just forget about. And obviously, it should be the other way around, where you should go and learn from the ones that you perceive to be wrong and mistakes, and learn from those. But we're going to redefine what a mistake is in a moment. So forecasting, and this is the biggest problem with forecasting, is that it'll never be right enough, correct enough to engender trust, confidence, and consistency. And the problem with human beings is that we have this thing called an ego, and an ego tries to always prove, protect, perfect, or people please. And the ego defaults to doing it. It's default programming. That's what it is. It's there to do, to protect us from certain parts of our life. And what it does with trading is it automatically runs all the time. And it's almost part of your identity, if you like. The degree to which you are trying to do those four things, perfect, predict, prove, or people please, is the degree to which you're going to make execution trading mistakes. It'll do your bidding and override the analysis that you've done. And this is why we need to spend more time on trading execution, and what we have to have, if you like, reprogram, redefine who we are, to be able to engender trust, confidence, and consistency, because that ultimately is how you make money. And the forecasting being wrong is our ego is going to take the bits that we are wrong on, and it's going to play havoc with our trading. And hence we're going to get poor outcomes, and it becomes a never-ending cycle that goes in the wrong direction. So forecasting, there are just too many variables at play in the market for anybody to be able to predict with consistent accuracy, to be able to have sufficient trust and confidence and consistency to be able to execute properly all the time. So these millions of variables that are interacting all the time, are going to invalidate predictions, and that is where we come undone. So, which then means there'll always be enough fear, uncertainty, and doubt, to lead the forecaster to making mistakes, if the forecaster, the predictor, the analyst goes on to actually execute and become a trader in the market. So analysis happens before execution happens, trading happens at execution time. So let's just expand a bit more on that. So markets reward the trader who consistently executes objective decisions that have an edge. That's it. In fact, that's what it comes down to. Consistently executing objective decisions that have an edge. And that's what your analysis should provide, is the edge. And then the trading portion, the trading part of you, your identity and who you are as a trader, needs to consistently execute that edge, those objective decisions that are supplied by the edge. So markets reward accountability. So, you taking account, to being accountable to your actions. It rewards responsibility. That is not blaming a third party or whatever, a politician or whatever. You're going to take responsibility for your outcomes, and all of those are just variables that are playing out in the world that you have to, your process, your routine, the way you trade has to take account of those. And what I found over 35 years is that price action has all of that built into it. So you don't need to worry about those variables because it'll play out in the price action. And if you can analyze price action, properly, not perfectly, properly, you will be able to, with enough degree of probability, you will be able to be very successful at this game, provided you can execute that probabilistic edge. So markets reward people who traders overcome frustration, either with themselves, the market, or analysis. So you have to get into a calm, peaceful state of mind to be able to execute properly, because if you get frustrated or angry, you might have heard the phrase, angry makes you stupid. It means that you get taken out of the flow of what you should be doing. It rewards people who persevere and who are resilient, who can become comfortable with being uncomfortable, because you'll never be, the ego and who you are as a human being will always be at play. There'll always be some degree of fear, uncertainty, and doubt. And what you have to do is overcome that to the degree that your resilience can get you through, help you to become comfortable, when you are uncomfortable, when times of discomfort, because the market's going to throw that at you in oodles, and you have to be able to overcome that. So this is what you have to try and achieve, is accountability, responsibility, overcoming frustration, fear, uncertainty, doubt, persevering, and resilience. And none of that has anything to do with analytical skills. None of it. When you're doing analysis, it's putting in the trade, and you're doing that in your own time, according to how you've actually set up your systems, your setups, whatever it might be. But then when it comes to trade, that's when the heat comes on. That's when the pressure comes on, because now you are putting money at risk, and now you are going to have to prove, perfect, people please, or prove, perfect, the 4 Ps of what your ego is. And that has nothing to do with analysis. So they are very, very, very different. So here's a quote. Sorry, this is a quote from myself, if you like. Your decision making in the heat of the moment is a manifestation of your trading identity, your mental skills, and your habits. They are not a manifestation of your analysis, although that does play a role. But the problem is that very few people, when they start, and it sometimes takes years, get to a point where they can execute their analysis exactly how it should be executed. So therefore, the outcomes that you get over the long term are definitely a lot more aligned to your trading identity and your habits that you build. So analysis is a path of least resistance trap. Why is it? Because it's tangible, right? It's something that you can touch and feel, whereas people don't want to mess with who they are. They don't want to go, playing around with their brain, if you like, their mind, their subconscious, their habits, their skills, their mental skills, because it just seems too hard to do. And hence people don't know what to do about it. So they default to this path of least resistance trap, which is analysis. However, the subjectivity and imperfections of analysis that keep traders' decisions emotionally reactive and inconsistent. Because why? The subjectivity means that you can always change your analysis to suit what you want to happen, what you would like to happen, what you feel, what you think will make you feel good if that happened. And so then you change your analysis, and that makes you inconsistent. And of course, your inconsistency leads to lack of confidence, lack of trust, and ultimately poor outcomes. So great analysts who can't pull the trigger, I've known plenty of them. There are tons of them. We've got customers over the years. Business has been going for 30 years now. We've had so many people come to us, who get exactly the same analysis as the next person. And you take two people, and they start at the same time with the same amount of money. They've got exactly the same signals, and one does better than the other. And that has nothing to do with the analysis. It has to do with how they execute the analysis. And all of that execution happens here, R2D2. And that is what we have to spend 90% of our time on improving, rather than spending 90% of our time trying to find the holy grail, the best indicators, the whatever it is, right? It's about getting what's going on between our ears right. And you can take a shottist, for instance, some examples, some real life examples here. Who anybody can once I did my national service, you get taught how to shoot a gun, right? Anybody can put a bullet in a gun and pull a trigger, but to hit a target 100 meters away, that's a totally different thing. So there's a difference between being a shooter and being a shottist. There's a difference between being somebody who runs and who is a runner. The runner doesn't have to think about or force themselves or build habits, or it has to build habits, but doesn't have to, put effort into, if you like, discipline to go for a run. They just do it. And that's what the difference is between somebody who can trade and somebody who is a trader, an excellent trader. And it's the same with, great coaches. You have lots of great coaches who teach and tutor and coach musicians or chess or golf or whatever it might be, who aren't great at it themselves. They know how to teach people. They know what should be done, but the execution, when it comes to doing it under pressure, they just don't do it as well as somebody else who becomes really good at it, right? So the difference is in the execution. And when you can't do it properly, when you can't take your analysis, when you can't take your training sessions and execute them properly, it manifests as mistakes. And these are mistakes of the mind. They're not mistakes of analysis, but it's very easy to go back and blame the analysis, because it's easier to do that. And then to try and get into this ongoing, never ending process of trying to fix your analysis, to fix your trading problems, when really you got to work on something else to fix your trading problems. And that is why sustained profitable trading happens in the mind, not on the chart. And this is where this massive difference is between the two. And to give you a quote from Mark Douglas, this comes out of his Path to Consistency workshop, which I did 21 years ago now. Analysis and trading are not the same things. No matter what your analysis says, the only way you can transform that analysis into profits is if you can execute your trades properly. Trading is a function of proper execution. And that Path to Consistency workshop, you won't find that quote on the internet anywhere, or even in Mark's book, Trading in the Zone, but it is absolutely spot on. So just to finish answering this question, proper execution is flawlessly executing your analysis that has an edge. So your analysis has to have an edge, and you have to know that it has an edge. Now, I'm not going to discuss that now. We'll get into that in future sessions. But flawlessly executing is in inverted commas, because it comes from a quote from Mark Douglas, which we'll handle a bit later in the next question. So what's flawlessly executing? Mistake-free, 100% mistake-free. It absolutely is, and that is what we have to aim at. So if you've got subjective analysis that you're changing all the time, how do you measure what a mistake is? So you have to redefine what a mistake is. And the definition of a mistake is committed when a trader does not execute their analysis precisely as defined in their trading plan. Now, out of all the people that watch this, I wonder how many have a documented, well-documented trading plan that defines, your mission, what you're trying to achieve, your vision of why you trade, that's your purpose. How many? And the next is your goals and objectives from a financial and a skills perspective, and then your how. Your how is how you are going to achieve your goals and mission, and that is where you define, absolutely, is very precisely, how you are going to trade. And that is what you have got to execute precisely, is what's in there. So it covers your timing, so your buy and sell, your entries, if you like, your risk management, your money management, and the routines that you set up. And that should all be written up in a trading plan. If it isn't, then you've got to do that. We're going to talk about that in future sessions. So where do most traders source their trading ideas? Well, analysis it's fundamental analysis, technical analysis. People go to newsletters, they go to, they hear it from mates, they're all over the place. They've got all this inconsistent sources of trading ideas. And even if all they do is technical analysis and look at the price action, we know from the statistics that 70 to 95% of people are inconsistent. That is why they lose money, which means that they are forever changing their indicators and their rules. And even if they use the same indicators, they are changing the parameters and the time frames all the time. And those of you who are listening have been doing this for years, maybe decades, might say, ho hum, I can remember those days. I did that for many years, and now you don't. Well, that's great, because then you'd be pretty close. But whatever source you get them from, they must have a probabilistic edge that you know before you start trading what your edge is. And we won't cover that now, but that is the role that analysis plays. Analysis is about finding, developing, designing, working out, calculating an edge, and then trading is about executing that edge. And the two are very different. One happens before you actually place the trade, and the trading happens at the time of execution, and that's where all the mistakes are made. So trading excellence is about executing that edge, that analytical, that analysis edge that you have consistently through thick and thin, through periods of comfort and discomfort. And that effectively is what the difference between the two is. And we started here because this is where the rubber meets the road, and what we're going to cover in all the sessions that come from here, today's session and sessions that come, is about how do we do that? How do we get that execution right?
All right. So, Gary, you just been breaking in and out a little bit there, but I think that's a fantastic start. Can you hear me still?
I can hear you clearly.
Hello, can you hear me still?
I can hear you clearly, yep.
Okay, fantastic. You've just been breaking in and out a little bit there in the end, but let's, I think that's a fantastic introduction there to what we're going to start to cover. And I can certainly relate to that. I feel like if you're at the beginning of this investing and trading journey, and maybe we need to go the difference between investing and trading, because they're much of much, it's just the way you say it or do it, right? It's just interchangeable words. But I feel like a lot of people have to go through that, the experience of not worrying about their mindset and all that goes with it, and the psychology and everything you've talked about that's not analytical or not trading, before they realize that how important that is. It's one of those things that I've experienced so much and when I first started, it was all about the analytical, and it was all about just executing what I knew, but it wasn't working on any of the things you talked about, right? So this is why, whether you're at the beginning of your journey or whether you're in the middle of it, it's just so important to know. And while some of this does sound a bit complicated, you can obviously, it's one of these things that we do really need to work on. Write the system out, that's fine. Have a system there, have an edge. But working on those habits that are going to make that a consistent process is so much more important than the actual system itself. So I'm glad we're going through all this. So look, that said, Gary, so what are the key skills needed to make traders or investors, however you want to call them, the habits needed to make them profitable then?
Okay, so I'm going to, sorry, am I muted? Can you hear me?
No, I can hear you. We can hear you.
Okay, good. Okay, so the take notes here. I'm purposely not going to put any slides up here, so you can take some notes, those of you that watch this. Right, so there are, now we've ascertained that you've got to go and work on mental skills, because as I said, none of the things that we need to achieve, accountability, resilience, persistence, responsibility, none of that happens on the chart. It all happens in your head, right? So now, and a lot of people don't work on the mental side of trading because they don't know what to do, and that is where Mark Douglas, you mentioned Mark Douglas. I met Mark Douglas in 2004. We had him come along to a customer retreat of ours that we had on Hamilton Island. He agreed to come to it and got to know him over a week, and we became friends. And he was my personal mentor, one-on-one for the next 11 years. And even though I was doing mechanical systems then, I'd worked it out myself that, it's reading books and meeting some guys in America, Perry Kaufman and a few others, were kind of people that I followed early on in the early 90s, Joe Kritzinger. I got onto the mechanical, systematic way of trading, but I still made mistakes. And so here I was, still not doing as well as the system until I met Mark Douglas. And that was the finishing bit of the jigsaw puzzle. And so I'm saying to people now, don't take the 14 years it took me. You can cut straight to the chase, and you can go and work on your mental side, from day one. And as long as you know how to do that, and that's what we're going to talk about. So the 5 mental skills are, and they've got to be done in this order. So the first one is accepting risk. And Mark was huge on this. So if you don't accept risk, truly accept risk, you are going to spend your whole life trying to avoid it. And even though you say, well, I understand that I'm going to lose, and I know it's going to happen, I know I'm going to go into drawdown, R2D2 over here is, which is your ego, which is going to be trying to protect you all the time and prove that who you currently are as a trader is correct. I've got this right. I'm doing it the right way. Even though that's going to happen, is that you are going to, your subconscious, if you like, is going to try and avoid the pain. It's going to try and avoid the losses. It's going to try and avoid the risk, because it knows those risks are what deliver the emotional pain, the emotional hurt that comes with losing, not being right, and leaving money on the table. And it's and unless you reframe that and truly, with every bit of who you are, accept the risks, right? Accept there's going to be loss, accept there's going to be drawdown. You are going to spend your whole time trying to avoid it subconsciously. So you have to get that right. Okay, and then once you say, right, I'm going to accept the risks, and that means, I'm going to place stop losses, I'm going to follow my stop losses, I'm going to follow my entries, I'm not going to worry, I'm not going to have fear, uncertainty, and doubt at the time that I place the trade. I'm going to follow my analysis. I'm not going to look back and see, when the analysis in this similar situation was wrong because it gave a lost trade. There are too many variables at play. You just have to accept the risk, right? The next step, so that's the first mental skill you got to work on. And there are drills and exercises that you can do to do this, which are not for today's session. The second thing that you got to do, the second mental skill, is to achieve objectivity. Now, objectivity is the opposite of subjectivity. And the only way you can become consistent is if you're objective. Now, objectivity is fleeting in this world and becoming less and less. So, objectivity means that you are unvarying, unchanging in your decision making, and you base it on some truths and principles. And there are undoubtedly truths and principles in the market that you have to understand from a knowledge perspective and then believe in, right? And then you develop some criteria that are 100% objective. So you can't question them. They're unwavering. You can't sit there and say these criteria in place, but I'm going to now debate them. I'm now going to have this self-negotiating process that happens in my head as to whether these objective criteria are in place or not. They have to be flawless. And I'll give you a definition, before we finish today, Mark Douglas's definition of what a trade entry is and what a trade exit is, right? Okay, so that's objectivity. That's the second skill. You have to become objective. The third skill is trust. Now, these are all skills. You can look this up if you don't think trust is a skill. It most certainly is. Now, you can't trust something that keeps changing and that varies. So that is why objectivity is the second skill that you have to work on. The third, being trust, is you have to trust in something. Now, people say, how do I trust something that isn't perfect? Well, there's nothing in life that's perfect. There's nothing that's 100% all the time. Everything has something wrong with it, and everything has something right with it. Now, you have to be able to have a set of objective criteria that have an edge, that's why I keep using it, that is sufficiently good enough, right? The forecaster, think of what I spoke about earlier, are sufficiently good enough to be able to trust. And so that is why objectivity becomes before trust. And then the trust is actually is effectively evidence, if you like, statistical evidence, probabilistic evidence that I can trust this, knowing at any given time that I've accepted the risks of when it isn't perfect. So you have to, and this is where your uncertainty, you get certainty in an uncertain environment by having an edge. And the example I'll talk about in a moment is being the house in a casino, right? So trust. So the fourth skill is confidence. Now you can't grow confidence in anything that you don't trust. So the confidence doesn't mean you're going to get the right outcome. It just means that you're going to execute your criteria properly. That's what it means. So you're not going to get the edge unless you trust it, and you're not going to get the edge if you're not confident about it. And so the confidence is also, and the trust and the confidence is not just in the edge, it's also in your ability to be able to execute that edge. And here's the other big one is the trust and confidence in the market that it is in fact an endless stream of opportunity and not just there to beat you up. So in future sessions we're going to talk about the really big picture of the market cycles that exist, which helps build that trust in the market as an opportunity providing haven, if you like. And so you need to have that confidence as well. That's the fourth skill. And the fifth skill, which has all the other four as prerequisites, is consistency. And this is the one that Mark Douglas was really big on. He was big on trust, confidence, and consistency, and objectivity. And well, in fact, he was big on all five. And he talks about accepting risk. You can't trade something. You can't accept something that you're trying to avoid, right? It's just the human mind just can't deal with it. So that is why you got to start with acceptance, and the last bit where you want to get to, the destination, is consistency. And when you become consistent, you effectively that mindset, that skill gets you through the periods of discomfort when we have short-term outcomes that our ego doesn't like. So those are the 5 skills, and it all starts with skill number 1, which is acceptance of risk. You have to truly, totally believe and accept with every bit of who you are that risks occur and that you are going to experience them. And the mindset you've got to get to is that you actually look forward to them. You've got to embrace those risks because they are the very things that provide the profitability that the market provides as well.
Yeah, I totally understand and relate to everything, and especially in my last 2 years of trading and investing since I started the technical analysis show. Those 5 concepts, I'd never come to mind that way, but a lot of those words applied to that in my experience, even for the last 2 years, and where I've become the most profitable. And it's not just because of where the markets are going. This is what I fear a little bit, is that markets are we're on a massive bull run at the moment. What's going to happen to all these people when they don't have these skills innate in them or starting to learn them? What's going to happen with all these investors and traders, right? Knowing that we're in a huge bull cycle at the moment. All right, so Gary, how are we going to put these analytical skills along with the trading skills together to become a profitable trader then?
Okay, just before I answer that question, what you really spoke about, they were in this bull market. Well, we're in a primary bull market of a secular bull market at the moment, and at some stage we're going to get a secular bear market. Secular bull markets last for many years, and secular bear markets last for many years. And when we get into a secular bear market, this whole trading gig is going to become a hell of a lot more complicated and difficult. But that's what we're going to cover in next week's session.
Yep.
So we won't get into it now. So effectively, how do they work together to become steadily profitable? Well, let me give you an example. I think that the best thing is that the analysis is the edge. That's where you got your analytical skills is you got to develop and design something that has an edge, and you got to be able to measure that. How do you do that? You back test through doing thousands of historical trades, if you like, theoretical trades, and you then work out what that edge is. So there are some analytical equations, if you like. There's Sharpe ratio, there's risk to reward ratio, Sortino ratio, expectancy, expected value, if you like, which comes from the worlds of statistics. They call it expected value. These all been around. They've got formula, and you just look at historically what your wins and losses are, how big the wins are, how big the losses are, following a set of well-defined, unambiguous criteria, which defines your edge, right? And that's where the analytical skills come in. And this is why Mark Douglas was so big on mechanical systems to learn how to trade properly. So that's the analytical side, and then the execution side is the trading skills, right? Those are the ones you need to execute with. And what I'm going to do here is use an example. I think is the best thing. So, and that example, a lot of people have difficulty with the example because it's a gambling environment, and that's a casino, right? But what I'm going to ask people to do is flip from being, the punter to being the house, because the house has an edge, has a positive mathematical expectation, has a positive statistical edge in all of the games, the card games, the table games that you play, whereas the punter has a negative edge, right? Now, the punter can get lucky in a small sample by pulling, the randomness, if you like, can help them win in a small sample. But the bigger the sample becomes of them playing a card game, or, and that is they've got to play according to the rules, because every game has rules, trading has rules, around it, that provided by the regulator and the markets and all that sort of thing. And so do all the casino games. So the punter can get lucky in a small sample, but over a large sample, that negative edge will play out. On the house side, they have an edge in their favor, and it's a skinny edge. So on a roulette table with 1-0, it's 0.0526 is the expected value. On a double, on a single zero, it's 0.052. Sorry, on a double zero, it's 0.0526. On a single zero, it's 0.027. That's a skinny edge, right? Just to put that into perspective, when we trade, we are working with edges, expectancies, expected value, mathematical expectation, whatever you want to call it, of around about 1 to 1.2 in research. So it's a much bigger edge, but obviously it doesn't happen as often because in a casino, they're doing it often. So now the casino has an edge, and they 100%, let's go through the 5 skills, accept that they are going to lose. They in small samples, maybe even big runs. But when they have a streak of losses against them by the whole bunch of punters that are on the other side, they don't stop. They keep going. So, and you can only do that if you 100% accept the risks that are involved with executing the game, right? So they have an objective set of rules. That's mental skill number 2. Of how they operate. So, when you go to the blackjack table, you go to the 7-Elevens, you go back, whichever one you go to, there are rules that the croupier or the operator has to operate under, which has been devised to be able to get the edge, right? So they're objective in following it. They also trust it. They trust the house, the edge that they have. They're confident that over a large sample it's going to play out. And because of that, they are consistent. So they consistently execute no matter what happens, right? And that is where the analysis of working out, what the edges that the casino has in all the different games that it had, that they play, that they offer, it combines with the execution of that edge. And so as a trader, we want to become like the house and have the edge and be confident in it, trust it, and it's got to be objective and then consistently executed. So that is where the two come together, and that is how the best traders separate analysis from execution, and they work on those skills separately.
Yeah. Well, look, I think I knew where you were leading to. I never heard that analogy, and I think it's a fantastic analogy of how about us as investors and traders, if you know anything about gambling, or I don't know much about gambling, how about we become the house versus the 99% of losers on the gambling floor, right? So I think that's a great way to look at things. I think I'm going to walk away today saying I'm now the house and no longer the gambler, right? So very good. All right, let's all these. We've gone through a lot already. It's a lot to digest. So I'm glad that we can watch this in replay if anyone wants to review. We'll have some show notes after this as well. Don't forget, if you've got any questions, there's none at the moment, but that's fine. We've got plenty to cover still. Put them in the live chat there. If you want, like and subscribe on the channel, and put any comments down on below as well if you'd like. But after all you've just covered already, Gary, which has been unbelievably, incredibly valuable so far. How do these skills, are they easily learned, or is it something that's innate? How's it?
Yeah, well, definitely not innate. In fact, what is innate is the opposite of what these skills. So we are born with skills that are the total opposite of how we should trade, and that is why it takes effort. Even the best discretionary traders in the world, had to go through this school of hard knocks. They just had to, and all that it comes down to is how quickly they learn what they got to learn. And some people never get there, and other people get there pretty quickly. But it's all learnable. And what I will do is I will share my screen. I've got a couple of slides to put up for this session. Well, what have I done here? Right. Sorry, going to get my technology skills. I'm just going to share this screen here. Share. It's a quote. It's going to be a quote from Mark Douglas, which we'll get to in a moment. But effectively, yes, it can all be learned, and it's done through. It's a structured learning process that people need to go through, like just about anything else in life. People have learned how to play musical instruments, learned how to play chess, learned how to play tennis, golf, which are obviously physical, bridge, touch type, even to come to something that everybody does, or to some degree touch types. I mean, I can't look at the screen and type, but you still touch typing. You know where some of the letters are, and then it's degrees of how well you do that. But I could still go for a touch typing course. I don't know if you've done one, but I would be taken through a structured process, learning process that would then that skill, despite it's my fingers that are hitting the keyboard, it's my mind that knows where those keys are. And building that trust and confidence in being able to look at the screen without looking at the keyboard and punch out words, right? And that requires you to go through a physical learning, a mechanical learning process, if you like, that actually then becomes mental. It becomes part of your subconscious. And this is where we take traders through this process to do it. And the way it's done is through experiential training, right? So actually doing the stuff, not just reading about it. And it's also about learning what the right actions are, and then taking those right actions and building them into habits, right? And if you can turn it into a habit, then effectively becomes a part of who you are. So I mentioned trading identity earlier. It becomes part of your identity, your trading identity. And it overcomes the innate pain avoidance, if you like, risk avoidance, automatic innate traits that we do have. And so we got to reframe, reprogram who we are with respect to trading, to overcome the default things that society has basically taught us to be. And that's why trading is so hard. That is why 70 to 95% lose in any given quarter, as the stats show us from all the broking houses in the UK and Europe. And then you've got to take those and practice them. So like anything else in life, you want to be a good golfer, a good tennis player, a good chess player, touch typer, whatever it is, you've got to practice. And traders, I don't know how many people listening to this actually practice trading. And I'm sure I've never heard of people outside. I ask them, how do you practice your trading? And they go, you've got to be joking. I said, well, do you practice maths? Do you practice your work? Do you, what is it that you do for, to earn a crumb? And they practice it, right? But they don't practice their trading. And mostly that is because they don't know what to practice. And that is really the problem. So trading is no different, right? And people aren't poor traders because of lack of data or analysis or information. There's tons of it out there. They're poor traders because they can't take that data and information and compile it into an efficient, easy way to orderly way. We've got to bring order to this, right? And then execute that order in a way that has an edge, and to do it consistently. So effectively what you've got to do is you've got to acquire skills. You've got to acquire these 5 skills that we've spoken about. And ultimately the goal is to become consistent, to achieve the skill of consistency. And it's a craft, it really is. And everybody can learn it. So how do we go about this? We've again gone to Mark Douglas, and this is one of his brilliant quotes in his material. He talks about the first stage is the mechanical stage. And this is on chapter 11, page 172. He said, in this stage, you build the self-trust necessary to operate in an unlimited environment. So the unlimited environment is the market. It's got almost an unlimited number of variables operating in it at any given time, which is why you can't predict and forecast with the degree of certainty that your default ego requires to protect you. And if you think any one trader is a variable, put them all into that, and then you bring in all of the external influences on the market, all the geopolitical events, the weather, everything else has an effect. They're all interacting variables. And people think that they are going to be able to predict and forecast with sufficient accuracy that it's going to overcome, their innate, ego and who they are, their default programming, if you like, to the degree that they're going to be good at this. They're kidding themselves. You have to really, build self-trust to be able to operate in this unlimited environment. When I put it that way, I'm sure it's no wonder that so many people lose in it. And then you have to learn to flawlessly execute, which is the quote I put up earlier, a trading system. And that trading system must have an edge. And the word edge, Mark uses it in his book, quite a lot. But the word edge comes from the casino environment. It's statistical edge, or it's expected value that comes from the statistical world as well. And you have to flawlessly execute that, not making a single mistake. So the question is how can you flawlessly execute something that keeps changing? You can't, right? Which means that you can't have subjective analysis. By default, you can't learn something and do it well if you just do it once. And if you change your analysis all the time, every single time, that means you're only practicing it once. How can you practice something that changes all the time and get good at it? You can't. It has to be the same. There has to be sameness in what you execute. And you have to do it flawlessly. Well, that doesn't mean you're not going to have lost trades, because it's an edge. It's not perfect. It means you're going to have lost trades. But if the lost trades happen and when you're flawlessly executing the system, that's okay, because that's the probabilities. That's the edge. And then you have to learn to think, train your mind to think in probabilities, which the 5 fundamental truths, which in Mark's book, anything can happen. You don't need to know what's going to happen next in order to make money in the market. The market is nothing. Every moment in the market is unique. An edge is nothing more than an indication of a higher probability of one thing happening over another. And you just, so that's what you got to operate. Those are the truths and the principles which get you to think in probabilities, not to think in perfection, which is what the ego calls for, and not to be operating out of a mindset that's always trying to protect, because the edge has losses built into it. And then when you think in probabilities, you think in terms of also losing. And if you can't do that properly, you're not going to execute properly. And it doesn't matter how good your analytical edges, you're not going to execute it properly. So you need to change how you think and create a strong, unshakable belief in your consistency as a trader. So that's what you got to go through, and that's how we train people. We take them through this process. It's a very specific skills acquisition trading plan. It's a very specific, intentional way of trading, and it's a specific way of coming out and executing the sameness in a way that you actually get to gain these 5 skills that we've spoken about, of accepting the risk and being objective, trusting, confidence, and consistency. And when you come out of this, this deliberate, if you like, intentional learning process you go through, you start acquiring and energizing those new skills, and they start building into habits, and you start de-energizing the egotistical parts of your identity that stop you from becoming a good trader. So you can learn all this. So just to also put a definition of what Mark said, I said I would put a definition up of what a buy signal is. Before we do that, this is what he says in his book in chapter 4. I'm going to teach you a thinking strategy that has at its core a firm belief in probabilities and edges. With this new thinking strategy, you'll learn how to create a new relationship with the market. And this is what we have to do to become an excellent trader. So the other thing I said I would do before we finished is actually give you a definition of what a trade entry is, according to Mark Douglas, page 190 of his book. A trade entry is the variables you use to define your edge have to be absolutely precise, right? He used to say no wiggle room. The system has to be designed so that it does not require you to take any subjective decisions or judgments about whether your edge is present. If the market is aligned in a way that conforms to the rigid variables of your system, then you have a trade. If not, then you don't have a trade. Unambiguous, black and white. That is how, period. And that is how you defined it. No other extraneous or random factors can enter into the equation. So this is the mechanical stage that Mark talks about, how people can, gain these skills to become a consistently successful and profitable trader. So no geopolitical events, no phone call from the broker, which you guys don't do, except for support. No newsletters, no mates down at the pub, no whatever. This is why we are talking about your source. Your source comes from sameness, from the same place. It's unambiguous. It's objective, right? And same for stop loss exit. Same conditions apply to getting out of a trade that's not working. Your methodology has to tell you exactly how much you need to risk to find out if the trade is going to work. And that, again, that's period as well. So that's how people that can go through this mechanical stage, they build the mental capacity, if you like, wherewithal to be able to execute their edge, probabilities, meaning losses, meaning drawdown, all that sort of stuff. And then they go through, and what we do is we teach them how to go through drawdown and come out the other side of drawdown, because if you've got an edge, you're going to come out of drawdown in the same way as what a casino comes out of drawdown. But the only way you can come out of drawdown is to keep on playing the game. It's an infinite game, and you have to keep on executing it.
Yeah. Fantastic, Gary. Thank you. I think this is the funny thing. A lot of people that might be watching this think that a lot of that applies if you're some sort of day trader that trades every single day. I'm certainly not a day trader. I would classify myself as more of an active investor. I might put on 1 to 2 trades a month, if that. And then there's the people who might just want to be investing in the long term, so dollar cost averaging and all that sort of stuff. This actually applies, if anything, so much more to the dollar cost averaging concept and getting into ETFs and all that, having a system behind that as well, and doing and executing consistently without, working on those skills is so important. And I know we're going to get into a lot of that in the coming, series, around ETFs and whatnot. But it just applies whether you think you're a day trader or whether you think you're a longer term investor. It all is relevant. So if you're just beginning, this is relevant. If you're in the middle of it all and struggling a little bit, this is relevant, right? So as complicated as it can sound. Yeah.
Absolutely. I mean, I've ended up, after 35 years of trading leveraged instruments, unleveraged instruments, options. The only thing I haven't done with any degree of consistency is futures. And I've ended up being a position trader. Now people go, what's a position trader? Well, a position trader typically, there's day trader, intraday trading, if you like. Then so a day trader by definition will close all positions before the end of the day. The swing trader has hold periods, anything from 1 to 2 days up to about maybe 4, 5 weeks, 6 weeks. And then you get a position trader, which is 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 months of average hold period from entry to exit. And that's probably also called an active investor. And I see somebody dollar cost averaging. Well, that's what I do with my grandkids and children. Is they're just not at the phase where they want to be active. They've got full with kids and all careers and the whole toot. So the ETFs, so you dollar cost average into ETF every quarter, regardless of what the market's doing, regardless of what the noise is doing, and saying to you dollar cost average. And if the market's down, you just get more units. If it's up, you get less units. But then obviously the units that you have grown, right? But that still requires a plan. It requires discipline. It requires putting all the extraneous factors, because the rule is, I just buy at the end of every quarter or every month or whatever it is, right? It still requires the same mindset, because otherwise, if you don't have it, you're going to talk yourself out of doing the things you should do and talk yourself into doing the things that you shouldn't do.
Yeah. I think it's perfectly said, Gary. I think we've given that much value today that everyone is just digesting all the information, and there is no further questions, which is fine because we are about to hit on the hour mark anyway, and that is exactly how long these shows should go for, which is, once again, I just want to say thank you for today, Gary. It's been an absolute pleasure to host and to start this series, and I'm really looking forward to the next 3.
Okay, good stuff. Thanks for having me. I'm enjoying it. Thanks, Roger.
All right. Thank you very much, everyone, for attending. There's just one more message I just want to say. Don't forget to like and subscribe. Gary, I know you wanted to also share some information around SelfWealth systems, so let's not forget that.
Okay, good point. So firstly, I've created a PDF for this, which is written up. So that'll be a handout, if you like, for this session, which we can put in the description notes. We also... we have an offer. We're a company, a training company, an education company, if you like, but we have our own technical analysis software, portfolio management software, and trading, mechanical trading systems. And the training that I've just described is what we take people through. It's a 3 to 4 month period, and we have, for people that get to watch the end of this, there's an offer, and that offer is worth about just under $3,000. A reward, if you like, for getting to watch this, and it may be resonating with you. And if you want to do that, there'll be a link in the description notes for you to go to and engage with us and learn a bit more about what we do and how we can help you, because that's effectively what we exist for, is to help traders get through this quagmire, if you like, and the fog and everything around it, because it's a tough gig. It really is. And shortcut the process. It's a 3 to 4 month. Well, I'd say it's at least a 3.5 to 4 month period, but there's $3,000 worth of reward, if you like, to if you want to go and follow up and see how we can help you get better at this fantastic caper called trading.
Yeah, well, fantastic. Well, thanks. That'd be great. And obviously, this is offered for SelfWealth clients. If you're watching this as a YouTuber, as not a SelfWealth client, there'll be a link down below as well, and you can sign up to get your 10 free trades, so you can execute, so you can become a trader. I know Gary's a great client of ours as well. So, really appreciate, once again, everyone attending. We hope to see you next week. It's the same time next week, 10:30 a.m. On a Thursday, Australian Eastern Daylight Savings Time. And other than that, thank you very much, everyone, and you have a great day ahead. Take care. Bye-bye.